Hello everyone and welcome back to the Financial Investor channel. Today we're going to be taking a look at a list of Dividend Aristocrats that I generated back in early 2020. We're going to go ahead and use this list of Dividend Aristocrats today in order to kind of thin it down and look for companies that are out there that could potentially be of value or undervalued here in the short term, where maybe they were beat down in that March-April period and just haven't recovered, but could have the potential to recover in the future. I think this would be a really good video for all those out there who are looking for some value in the market but are not able to see it. So this is a list that I generated quite a while ago, so we're going to go ahead and use it in order to quickly thin down the list of companies that are trading with a current 1-year time frame where the yield is trading above the current price, meaning that it could potentially be undervalued here in the short term, but is slightly making its recovery. And Exxon's a really good example of this. And see, which of these companies would you invest if you were to pick, say, one or two of these? And we'll go over a few financial metrics as well in this video. So with that said, if you are brand new to my channel, have not yet subscribed, definitely hit that subscribe button below. If you do enjoy this video, find it helpful, entertaining, give this video a thumbs up. And if you have any comments or questions, go over any of these companies. If I miss any of the Dividend Aristocrats, go ahead and let me know in the comment section below. This is a list that I generated back in early 2020, so I haven't removed any companies that could potentially have cut their dividend here in the short term or have actually met the 25-year rule, such as Realty Income. That is one that I know just hit it this year, but I haven't added into this list. So number one, Exxon. It does have a orange over the blue, a yield over the blue, so I'm going to go ahead and leave it in there. Next we have Chevron. Chevron slightly trading over that yield. Going to go ahead and remove that. Nucor. This is one that's been interesting. I know it was beat down in the short term here. You can see it's also recovering slightly, but it has actually traded above the yield. Now I'm going to go ahead and remove that as well. Air Products price is almost back near 52-week highs there. There we go. H.B. Fuller price trading almost back to those 1-year highs, but it is slightly above that yield. Sherwin-Williams trading, that's an expensive price there, $576 there. Universal Corp, yield over price, going to go ahead and leave that one. Leggett & Platt, yield slightly over the price, we're going to go ahead and leave that there. Kimberly-Clark, this one essentially trading almost near 52-week highs here for the year. It's almost recovered. It is trading over that yield, so we're going to go ahead and remove that. Archer Daniels, price over the yield, remove that one as well. Pepsi, yield over price. So a lot of this is going to get thinned down pretty quick. Now, this is the first metric I use just because it's very visual. I can see really quickly, is that price trading above or below the current price? If it is trading above, if the yield is trading above the price, I will keep it. If it's not, I will just remove it. Right now, I'm just looking for value. This doesn't mean that these companies are worth investing in. This is just that they could potentially, they could potentially be of value and be worth taking a bit further deep dive. Take a look at their balance sheets. What is their revenue, their income, their free cash flow looking like? What's their earnings? What have their earnings done during this downfall? How are their first quarter earnings? How are their second quarter earnings going? What was their guidance? There's a lot of metrics to take a look at. Tootsie Roll Company, they're trading slightly below. We'll keep that in there. Coca-Cola. What is up with Coca-Cola? I've seen this one mentioned a ton in the dividend groups. Is Coca-Cola worth investing here in the short term? Obviously, it's trading really at a really good price right now, way below. It's normal for the 1-year mark. Their Tanger Factory Outlet. This one recently, I'm not sure if they cut their dividend, but we'll go ahead and leave that one in there for now. We'll do more research. I forgot if they were recently suspended their dividend. I believe they did, but Old Republic there, yield over price. Eaton Vance, price over yield. Community Trust Bancorp, yield over price. Continuing on here, this, it's so flat, it essentially looks like it's even. I'm going to go ahead and leave that in there. FRT, that's a financial. I know financials that got beat down pretty hard here in the short term as rates are continuing to fall faster and faster. I'm getting an email every single week now that rates are getting cut on a number of my high yield savings accounts. So even if I'm not signed up with Marcus or CIT Bank or Ally Bank, I'm still getting emailed from them that they're cutting their rates down. So there's a bunch of financials right there. all in a row. Aflac, I know that's a really popular insurance company. I know a lot of investors have recently told me that they're not investing in insurance. So there's a yield of a price. And the next metric after we kind of go through this group here, Avi. Avi is a very nice one here. I've been recently buying and selling this one as it gets up to about $97 and actually exceeds there. I've been selling it, waiting for it to kind of drop back down to 92 and rebuying it. So Johnson & Johnson, J&J, really great company there. Medtronic, yield over price. That's an interesting one there I had in the past. Abbott Laboratories, yield over price. So now, yield over price. I have to scroll down here and we're on West Pharmaceuticals. Hopefully I can kind of get rid of a few of these and then I don't have to have the whole scrolling function. Or maybe I can zoom out here. Maybe I can zoom out. There we go. And continue on from, I believe I was right around here. So we'll zoom back in here in just a second. Hopefully I can kind of get this list then down to the point where we'll just kind of have a few, and then the next step after here will be to remove companies that have descending revenue, net income over the past 10 years. So we want to see companies that have at least been able to make a profit over the past 10 years. We don't want a General Electric in our portfolio. We don't want a Ford, which have just been declining over the last several years and just has no growth, has no really good potential for for the future. So we don't want that at all. Walgreens, man, Walgreens has just got that nice yield. Genuine Parts, McDonald's. That one just slightly, I would say that's slightly, we'll leave that one in there for now. That's about slightly there. Walmart, WW Grainger. Okay, we're thinning down our list here almost to the bottom now. I'd be interested. I'm not familiar with Brandy Corp. So if it makes it through our next, look at AT&T, 6.81 yield. I have recently started buying some AT&T up the last few weeks. I think I hit my mark of where I want to be investing in here in the short term. Whoops, I got two of them tagged here. Ed, look at Ed, Consolidated Edison. That one has a very nice yield, 4.24%. National Fuel & Co. So utilities have also here been beat down in the short term. So if you're looking for some value out there, utilities, everyone's kind of leaving them alone because they're kind of beat down here in the short term. But when there's blood in the streets, that could be the potential to be buying up some great utility companies with long histories of growing and paying out dividends that are just kind of beat down here in the short term that are potentially potential in the future for good growth. So we're winding down here to our last few. And the next step here is I'm going to go ahead and activate revenue and net income. And we'll take a look at these metrics here. And PPG, okay, that one, we'll remove that one. Okay, so we went over price and yield. All these companies here that we have remaining are currently trading where their yield currently exceeds their price for the 1-year mark. Now the next thing I like to take a look at is revenue, net income, and free cash flow over the past 10 years. Are these companies moving in the upwards direction? I'm going to go ahead and put in the percentage in here. That way we can see their percentage growth. So Exxon, for example, as of looks like maybe 2013, 2010, way back when here, their revenue started declining. Let's go ahead and bring in their earnings as well. So we'll look at their earnings per share trailing 12 months. So here we go. Earnings per share down at the bottom of the green. Everything's been declining. Revenue's been declining. Net income's been declining. Earnings per share and free cash flow, just everything is going downhill. There's no upside potential, especially going into this pandemic here in 2020. They've just been continually going downhill. Here in 2017, they made some progress, the potential moving forward, but it just hasn't been, doing so well here in the short term, and could potentially be just continuing its trend for the downward. So that's one, for example, we're going to go ahead and remove Universal Corp. Everything's in the negative there, not worth taking a look at. Leggett & Platt, everything's moving to the upside. Very nice revenue growth of 4.1% on average per year. Everything else up there as well. Waco Group, Only thing here in the red is free cash flow, but everything else is positive as far as their revenue. It's moving to the upside. Net income in the orange, moving to the upside. And their earnings, 6.2% on average per year over the past 10 years. That's pretty good for their earnings. So I don't bash them for their free cash flow. Uh, that, depending on the type of company, could be up, down, depending on the year for them and what's kind of going on. So I don't beat on the companies for having the free cash flow being down. We'll go ahead and remove that metric. That way we're just looking at revenue, net income, and earnings per share. And we want all three of these metrics moving to the upside. So VF Corp, positive there. So as long as we're not seeing any negative here in these trends, I'm going to go ahead and keep them and continue on. That way we're not spending too much time on these companies. So we do have net income here in Tanger Factory Outlet. So this one here in the short term, this is a real estate investment trust that is in retail outlet malls. So this one, for example, it has had its stores getting closed, stores within their malls getting closed, not opening back up. So here in the short term, I do believe that Tanger Factory Outlet did suspend their dividend. So earnings per share there with a Universal Health Realty Income Trust. So this is another REIT, it looks like, and this one has its earnings per share being down in the negative. So this is actually a REIT, and we want funds from operations. I'm not sure if I have funds from operation down here. Funds from operation, trailing 12 months. So we want to look at funds from operation in these real estate investment trusts. So here we are in the red. So they're positive as far as our funds from operation. We can actually look at Tanger Factory Outlet. That's probably what I should have done there. So here we have funds from operation, and even that is in the negative. So that's a negative 22.83% for their funds from operation, and also their net income also in the negative there. So both of those actually turned out pretty bad for Tanger Factory and Outlet. But Universal Health Corp, income trust, Realty Income Trust, that looks pretty positive there in the short term for their funds from operation. Moving on to the Federal Realty Investment Trust. This could potentially be another REIT, but all looks positive there. We'll leave that one in there. Ben, all negative, all semi-negative there. Essex Property Trust, this is one in my portfolio, all there clear. Tompkins, all positive. Cincinnati, we got some negative in there. Let's remove that. First Source, positive. So here we go. We're just kind of thinning down our list here. You can kind of see the process here. And these companies, while they were kind of beat down in the short term, we're getting a pretty good list of companies that are trading, not near their 52-week highs. They're still trading below maybe their 200-day, 50-day moving average. They're also trading where their yield is pretty high here in the short term, so they could be offering a nice value. And also you're buying into companies that do have rising revenue, rising net income, rising earnings per share over the past 10 years. Here in the short term, they may be going through a little bit of a hiccup, but as we move, in the upcoming years, this one here, for example, this has been downtrending for quite a while, and it's negative now. So this is their revenue. As of 2014, their revenue just hasn't been able to keep up, but this is McDonald's. So they've been going to, what is it? They buy the real estate and then they rent it out to the owners on top. I forgot, I can't think of the word right now. So this is a weird one right here where McDonald's, I know, for example, that they're transitioning from a franchising. They're franchising out. So they buy the real estate, the parking lot area, they build a property on it, then they rent that property to somebody that wants to franchise. They buy the franchise at McDonald's, and then they pay McDonald's to use the name and the products and such, and then they collect the income and pay up to McDonald's. And so they're not having to get paid with the taxes, the insurance, all the liabilities that come with owning that building. They just own the land and get paid for it. So this, for example, I know that revenue is declining here in the short term with McDonald's, but eventually this will kind of bottom out, and their net income is what's been increasing just because all those expenses that come with the actual business itself are on somebody else's hands. So I'm going to go ahead and leave McDonald's on there. That's one example that I do know is, transitioning that way. Brandy Corp, I'm not familiar with that company, so this could be in the same moat, not moat, but it could be happening the same way. AT&T here in the red, earnings per share has been on the decline. And it looks like it goes through these little bubbles here where it just has a really good spike on earnings and on net income and earnings, all sort of spikes, and then it kind of drops down, and then it spikes, and then it kind of drops down. So, this one here, over the past 10 years, their earnings per share is in the decline. I have bought a little bit more AT&T here. Whoops, I should have removed that one. Yeah. We're not playing favorites. Anything that has negative, we'll go ahead and remove besides McDonald's, just because I know the story there. And I don't believe that McDonald's is a bad company to invest. Revenue here, this one just consolidated Edison. This is a utility company, so it's kind of interesting to see. They're probably in the same area. Maybe they're floating the taxes, all the physical expenses on somebody else. But you can see here that their net income, okay, their net income has also grew. In the short term, both net income and earnings are in the negative. You know what? Just to kind of be sync across everything, I'm just going to remove anything that has negative. And I'm spending way too much time here now. So let's go ahead, remove anything that's negative, and proceed on to the next one. Okay, so we're kind of getting down on our list here. And there we are. So here we are with our last companies here that are these are all trading here in the short term with a yield of a price below their 200-day, 50-day moving averages. These are also companies that are all have had rising revenue, rising net income, and rising earnings over the past 10 years to the upside. Here in the short term, yes, they may have been beat up here in the short term, but with that, let's go ahead and move into the other metrics. Let's take a look at their price to sales, their current PE, and their price to book. Now, I'm not going to remove any companies that are, for whatever reason. These ones right here, I'm going to go ahead and just kind of copy these. I'll copy these over into a Facebook page and post it over my Facebook channel, my Facebook page. But I think that these could potentially be worth researching a bit more of. There's a couple of financials in here. There's consumer defensive or consumer cyclical. I can't say the word anymore. Yeah, it's after midnight. There's utilities in here. There's retail with Walgreens or healthcare, retail style, and a few others. So I think there's a good mixture of insurance in there as well. So with that, we're going to go ahead and just take a look at their current. Let's go ahead and bring in VU. And we'll do VU. That's a terrible way of doing it because it doesn't actually show me their current PE. Let's go look at the PE of the market. I do have, I think this one tells me VU. Tells me it's current, of course. It never works when I want it to. Okay, so drag that elsewhere and see if I can bring up. So I don't want to take too much time on this. I was really hoping to just pull up the PE ratio of the S&P 500. I'm sure if I just type in VU PE, nah, it doesn't tell me. Okay, anyways, I think it's around 25 if I'm not mistaken. So what we're looking at is just its valuation in comparison to the total market. So here, for example, Leggett & Platt has a PE of 15, and it's actually pretty low here in the 10-year. If you're looking at over a 10-year period, here's Leggett & Platt trading at almost a 10-year low. Also, its price to book is at a 3.7, and its price to sales. Leggett & Platt, I believe they sell furniture and other items. I believe I would have to do a little bit more research into this one just to kind of refresh my memory, but I think they're more sales driven. So we're looking at price to sales, and that's at a 1.0. So essentially, you're buying the price for the sales of the company. Waco Group, here we go. This one has a PE ratio of 11.34. This one also has a price to book below 1 and a price to sales below 1. Interesting. Waco Group is a retail distributor. They sell different items online, footwear. VF Corp, this one, really high PE ratio, 37.99. That's very high here in the short term for a PE ratio. We can see that their price to book is also at a 7.2, which feels very high. And price to sales, I think VF Corp is a sales driven company, so 2.3, not terrible, but their PE ratio looks like, it's spiked here in the recent term. So maybe their earnings per share took a nosedive here in the short term, which has driven up that PE ratio as high as it is. So I'm not going to remove it, but I think it's pretty high here in the short term. Carousel company, so PE at a 15.26, not terrible. PE, price to book and price to sales both below 3, so both of those valuations look pretty interesting. I'm not familiar with this company as well. Carousel company, so I'm not sure. Tootsie Rolls, candy company there. PE ratio very low at a 19.4. I think this one's going to trade pretty high as far as its price to book and price to sales just because of the name. But looking at the PE, look at this 10-year period and this price earnings. This company here in the short term, I bet if we bring this company in, we'll see that their earnings has actually done really well here in the short term. You can see earnings as of 2020 moving to the upside. So their first quarter in 2020 continued very strong here even during this epidemic. That's why this PE ratio dropped so hard, because their earnings spiked and their price remained stagnant or moved to the downside just with the rest of the market in March, April. This price hasn't really moved up with their earnings, but their other metrics, they're pretty good. What was the other company? VF Corp. So this one here, this is the earnings per share. You can see the earnings per share took a nosedive. Earnings per share nosedive, their PE ratio skyrocketed because of their earnings. So that is why you see that PE ratio, jump as high as it did, and almost doubled here because their earnings dropped by, almost half there in the quarter. And kind of moving on, Coca-Cola, here we go. Continuing up, first quarter of 2020, they're continuing moving higher. They had a little of a weird blip here back in 2017, 2016. Looks like they recovered well. Price to earnings is at a 19.69. Price to book doesn't really matter. This is a sales driven company, but it does trade pretty high for the sales. I think it just trades high just because of the name Coca-Cola. But if we looked at that price as we did earlier, it's actually trading pretty low and has a nice starting yield of around, what was the starting yield on that one? I think it was around, 3.55%. You're not getting that 4% starting yield, but look at this. Over the past 10 years, 3.55 is pretty high. So it's very rare that you get a 4% starting yield, but you had it back in March. But right now, taking that 3.55% starting yield with Coca-Cola could be a really good long-term buy and hold for this company. So removing that one, going on to Community Trust Bancorp, you can see this one, financial company, took a nosedive with their earnings. Price to earnings didn't actually spike as high as it should, I think it should have, but that's because the price probably remained low and their earnings fell low, so it kind of stayed flat. The price didn't shoot up as much, in the short term, so their PE remained kind of flat. Now this is a bank, so we look at the price to book. Price to book on this is actually trading below 1 at a 0.92. It's an asset-based company, so it's a book valued company. So we're looking at the blue number there, 0.92. So I think that looks pretty good as a financial company. This is one that I recently added to my portfolio. It is continuing to get beat here in the short term just because of how yields and the interest rates are kind of moving here, with the Fed just injecting money like it's water or something. Here we have Universal Health Realty Income Trust. This one has a very high PE ratio, but it's a real estate investment trust. So PEs, I don't believe they matter too much in REITs, but we're looking at their price to sales, price to book. I'm not sure what metrics that you look at really for a REIT. I know funds from operation is always a really good one just to kind of see how much cash flow. You have to look at their cash flow, look at their expenses. Is their income covering their expenses? How much debt do they have, etc. But I don't think these metrics are way too important for measuring a REIT. So we're going to go ahead and skip it for now. Federal Realty Investment Trust, again, 18.83. Price to book, asset-based company, 2.7 seems pretty fair. Here we're looking at their earnings. It was moving earnings year after year, all to the upside here. 2020 financials got hit, so its earnings did dip here in the first quarter. It may recover here in the second quarter, third quarter of 2020. That needs to be seen. Essex Property Trust, this one here in the short term recently got beat, but why? Look at their earnings, first quarter of 2020 moving to the upside. Take a look at that PE ratio. Essex Property Trust in a 10-year period, you're looking at a PE ratio of average of 40. And here you have it today at 24.14. This, in my opinion, pretty good. This is another real estate investment trust to potentially look at. This is one that I hold in my portfolio. It recently went negative just by a smudge, so I do plan on adding more to this position here in the short term. It is an asset-based company, so 2.4 there for the price to book, and its earnings are continuing to move higher year after year here, even during the pandemic, moving higher. First Financial Corp, we're looking at price to book, asset-based company, so it is below 1 there. Sales, not too important. PE ratio at essentially a 10-year low of 9.03 with earnings that, generally trend sideways here for the past 8 years, but as of 2018, 2019 has just begun to move to the upside. So maybe they changed their tactics here with what they do for their business. That would be something interesting to go look at. What did they recently change in their business model that caused them to move here in the short term in 2019 and entering 2020 to the upside? Maybe they took on some new services, some new products that they're offering their customers, and that is why this company has more to offer to the investors that invest in this company. Tompkins Financial Corp, ticker symbol TMP there. This is another financial. We're looking at the price to book of 1.3. Again, PE at 13.5 seems pretty average here, not really below average. Actually seems a little bit higher than average for the past 10 years. It's right in line there. Also, earnings per share dropped here in the first quarter of 2020. Been pretty much flat essentially here, except for 2019, maybe with rising interest rates that caused their earnings. That's probably why we see a lot of financials with their earnings per share rise in that 2018, 2019. That was in a rising interest rate environment. Rates across the board for financials that were increasing, that caused them to be able to lend more money out and get a higher rate return back when they're able to make loans on mortgages for 5-6% versus that traditional 2 to 3% that we're in right now. So they're taking in a lot more money back then with their mortgages and other loans and stuff. So that is that one. First Source Corp here. Earnings moving to the upside here in the short term. Did fall here in the first quarter. PE pretty low here for the 10-year, so it could be really something to consider. Also, price to book 1.0 and price to sales 2.7. Not so important for the price of sales. This is another financial, so we're looking at that 1.1 asset. So it's a 1-for-1. Aflac is an insurance company. I'm actually surprised to see Aflac not do so good here in the short term of 2020. I would be surprised. I'm actually surprised not to see them meet or exceed their earnings goal. I don't know if they met. I believe I don't know offhand, but that would be something. Maybe their first quarter, first quarter earnings is generally maybe lower, and then it kind of picks up for the remainder of the year. So maybe this is just a little blip that just kind of happens. Price to earnings, not low, but very close to low over the past 10 years. Also, take a look at their price to book and price to sales. This is a sales driven company selling their insurance policies to members. So this one's at a 1.2. And price to book, for all their assets in their company, you're buying their price actually below 1-for-1 value there. Commerce Bank Shares Inc. This one, financial. So we're looking at the price to earnings. I think this is a bit high. So earnings fell in the short term, price probably rose, causing our PE ratio to be a little bit higher than average in the short term. Also, look at the asset base, financial asset base. So this one's actually high at a 2.1 versus the other financials that we recently hit in the list. So I think this one, if we looked at the price on this one, probably a little bit higher here in the short term. Versus, we can see the price did almost recover back to highs, but recently broke back down. So maybe investors saw that they missed their mark on their earnings. Also, maybe just trying to trade in a little bit higher than normal. So continuing on, Medtronic PLC, earnings per share Doesn't look amazing. 2015 just earnings per share kind of flip-flopped, not really having that nice steady growth to the upside. And we can see PE ratio. So their earnings kind of jig-jagged in here, and with their price, maybe I don't know where their price is. Let's go ahead and bring their price in. I'm actually kind of curious. So their price kind of followed their earnings. Price went up. Stock market, their stock price went up. Earnings were going up. Earnings went down. Their price kind of fell for a little bit, and then kind of recovered, and then fell again. With the earnings. So the price kind of follows their earnings here, and I would say that Medtronic doesn't have that nice steady upside potential that other companies have had on this list. Okay, we have MSA Safety Inc. Really nice earnings here in the short term. Moving to the upside, PE ratio trades fairly high. At a 27, that's pretty high even for the S&P 500. But this company looks like they trade at a premium. You can see over the past 10 years, that's pretty normal for them. This 27.21, it doesn't usually get any lower than that. And that's with their earnings having shot up here in the short term and actually doing well here in 2020. Price to book at a 5.9. It's a sales driven company and it has a 3.0 sales driven price to sales. So I think this company is actually a bit rich. And if we bring in their price here, you can see here, it is very expensive. And this all recently happened over the last few years. So interesting to see there. We have Tenet Co. Earnings per share. Recently did a V, kind of recovering there. Kind of interesting. Why are these numbers appearing here? What do I have that's different? But I'm not sure why this 2400 is showing up in here, because none of these numbers are showing 2400. But anyways, I'm not sure what Tenet Co is. It doesn't kind of ring in the name of what it could be a REIT, like a real estate investment trust. It could be something with a tenant, but who knows. Walgreens, the healthcare um, sort of retail business. This one had been doing really well. I've been invested in Walgreens for quite a while, and they did recently have an issue back in 2019 where their earnings just began to slip. And this pandemic here in 2020, where they just had to close up some of their stores, just has not been too well for them. So their stock price did suffer here in the short term, actually trading near 52-week lows. Oh, well, 2020 week lows. It just hasn't recovered here in the short term. That has caused their PE ratio to fall to its 10-year low of around 10.98. It is trading at a very, very low sales number of 0.27 and a price to book of 1.5. I'm actually surprised with Walgreens here where their price is at. I think that investors would be more open to invest in Walgreens, but I can see with retail is one of those weird things where if they have to close the doors for whatever reasons and they're just not able to get traffic through their stores of people buying their products, it's just not one company. There's much better companies out there with much better safety on them versus a retail company. So I can understand that. Black Hills Corp, we have a rising earnings. We can see here in 2015 to maybe 2017, they had a bit of a hiccup there. Maybe they were doing some transitioning or just maybe loss of data here. You can see the PE ratio just disappeared there. So something happened with their earnings and it came back and they were strong for a while, but have been recently going down here in the short term. I'm not familiar with this company, so if you know, let me know down in the comment section. Price to earnings at an 18.03, price to book and price to sales there below 3. MGE Energy, I would think this is a utility company here, so here we go. Trading at a pretty high PE ratio. That probably means that the price has kind of moved. Okay, it didn't really move higher in the short term. It's still, let's see, 2020. Oh, okay. So hasn't recovered, but their earnings, kind of the interesting one. I think that's a bit high for utility, 24.77. Not the most amazing earnings. It's been steady. I would actually say that this is actually pretty steady earnings. Year after year, they're raising their cost for their services. People are paying it. Sometimes it goes pretty high, but if we just kind of look at we made a line from here to here, it'd be pretty consistent growth. and it really doesn't ever go to the downside. So maybe that's why it trades at a bit of a premium for its PE and its price to sales at a 3.9 sales driven company there. So maybe it's trading a little bit of a premium on purpose. Now, UGI Corporation, this is another utility. I believe I'm invested in this one. This one has a 17.64. It has a earnings per share. Recently, it kind of dipped down pretty hard. Price to book and price to sales both below 2. California Water Service Group. This one, really high PE ratio of 43.71. This is because their earnings just shot down below 1 there. So let's look at their price. So their price made a bit of a recovery here in the short term, but their earnings just did not go in sync with them. So their PE ratio just kind of shot or has been remaining pretty high. They don't really generate the earnings per share to evaluate their price. So that's why that PE ratio trades so high, and their price to book, price to sales are both right around 3 or higher. And American States Water Company, this one has rising, very nice earnings per share over the past 10 years, just nice and steady. You can just kind of draw an arrow out from here to there, and it makes it work. That's probably why it does trade at a nice valuation, high PE ratio of 33.47, and also price to book and price to sales both over 3. So this one just kind of, you pay the premium for this specific company just because it does have that rising steady earnings, and it has a very high PE ratio just because of it as well. So it's very nice and consistent. So we ran across a couple companies in here that are all very nice and consistent. I didn't make a list in my head of which of these companies would actually be worth looking at. I know Essex Property Trust is one I will be taking a look at myself to be added more of in my portfolio just because it is a holding already. But of these other companies, we looked at a number of them that are in retail, that are in communications, that are in consumers. Tootsie Roll and Coca-Cola both look really good. Then we had financials in here. We had some real estate investment trusts. We had insurance. We had some, I think that's healthcare, Medtronic. I believe that's healthcare. We had some other, I'm not sure what MSA Safety is. This could be another REIT, retail healthcare right there, and some utilities down towards the bottom. So let me know, did this video kind of was this video pretty interesting? Does this help you in any way looking for some potential value? I think there's a lot of value out there in these companies. I would like to take more time to dive into these companies a bit more, but we're already at nearly 40 minutes. So I think that is about time to kind of wrap up this video. So hopefully you guys found value in this video and that you guys go out and explore some of these companies. Maybe you're looking for a utility, maybe you're looking for a financial, consumer defensive or such. So let me know in the comment section below if this list is helpful, if any of these companies are ones that you're going to be going and checking out. If you haven't yet subscribe to the channel, and of course give this video a thumbs up, and I will see you next time. Have a great day. Bye.